Welcome to TheoTrade. This is Don Kaufman. It's June 9th, 2023. We are just seconds after the cash close here on this Friday afternoon. The S&P futures finishing the day, well, for the most part, massively unchanged. Nasdaq up listlessly. And of course, it's the same Nasdaq stocks that continue to be the talk of the entire trading community. Feel the wrath of the Nasdaq. We're going to break down a couple of the Nasdaq stocks, specifically digging into some of the order flow. And really, I'm actually going to show you some of the opportunities that exist in a few of those Nasdaq stocks here. Let's get right into it on this weekend's update. Again, feel the wrath of the Nasdaq. All right, right up front, I want to explain something that I don't think everybody actually understands, and that is here in the QQQ and in the Qs. If we bring up auto expected moves, this is going to catch, I think, a lot of people off guard, and that's this. Were you aware that the Nasdaq finished the week completely unchanged? We started off, obviously, on Monday, no volatility. Tuesday, no volatility. Sell side activity, of course, on Wednesday. We rallied back for the most part on Thursday, and today's trading session, look, the Nasdaq finished up some 57 handles. But for the most part, it literally, okay, the week is completely and totally unchanged. And the reason I wanted to bring that to your attention just right up front, yeah, feel the wrath of the Nasdaq, except the Nasdaq is getting all kinds of funky, if you will, in just the last couple of trading sessions. Degrees of weakness, the order flow is getting all kinds of strange out there. Again, we finished the week completely flat. And with that, as I said, I'm going to dig into some of the order flow. Look, it's still the same, the usual suspects, if you will. We can bring up Microsoft, talk about it till we're blue in the face, but I love to use this auto expected move. Were you aware that Microsoft actually closed outside the lower edge of its expected move? Right? Microsoft's actually breaking down a little bit. Apple, okay? What's to say about Apple other than those goggles are ridiculous? It finished the week completely unchanged, right? Kind of taken out of the equation. We can talk about Netflix, all right, but Netflix is not market cap. Okay, it's fodder. It's an afterthought, and I really do mean that. Like we can talk about, Netflix broke to the upside. Okay, that's great. It's a $186 billion company. Golf clap. No one cares at this point because Netflix is not enough. We can look at Amazon to a degree. Apply auto expected moves. Amazon actually finishes the week slightly down. Taking a look at Google. Google's actually the lower edge of the expected move. Again, one of the things I'm trying to point out right up front here before, feel the wrath of the Nasdaq. The irony that the wrath of the Nasdaq is some of these individual stocks got beaten up a little bit this week. Let's move on to Meta. Okay, where's Meta? Outside the lower edge of the expected move. Okay, now let's get crazy. You know where I'm going with this. Tesla. Look at Tesla. Right there, people. If you're looking for, if you will, the sustaining bid into the Nasdaq this week, okay, it's Tesla. And again, Tesla actually started breaking to the upside really early on this week, and this thing is a full 2.5 deviations outside, and then of course NVIDIA. Okay, and what did NVIDIA do? Absolutely nothing. Actually, slightly down on the week. Okay, this is exactly what I was talking about 2 weeks ago. I entitled one of the videos the weekend update. It was the one stock market. Okay, boy, that's spot on. You've got one underlying alone. Okay, that is now responsible for the Nasdaq holding it together. And that's exactly what I wanted to point out right up front. For those of you that are in the technicals and so forth, okay, take a look. Don't take my word for it. Start taking a look. You're starting to see some degree of breakdown in a couple of these Nasdaq stocks. Now, that doesn't necessarily constitute that we're going to continue to break down. And I don't want you to take it that way. But when you start looking at individual products, right? And we are going to look at individual products over here. Okay. What I said, mega market cap, okay, squeezes invert IV skew. Now, again, that's one of my bullets in here. Look, I speak total geek, right? What total geek basically means, mega market cap, which is just market caps, 500 billion and above, trillion-dollar companies. But when you start to look at something like Tesla, let's look at Tesla, its market cap over here. Okay, it's cool, $775 billion. Great. one of the things that people don't get about Tesla. Yes, it's completely like, vertical trajectory to the upside. But what I really want you to look at is it has a wild inverted implied volatility skew. First of all, huge contract size. Thing traded almost 5 million contracts just in Tesla today. When I say huge contract, what did Microsoft do? Just to compare, and everybody knows Microsoft, but Microsoft, what kind of contract size? Oh, it did 400,000 contracts. Okay, let's get crazy. Let's look at Apple, right? The most prestigious stock in the entire world. Yeah, it did 1 million contracts. Okay, what else you got? All right, NVIDIA. Okay, Mr. Toad's wild ride in NVIDIA did about 1.4 million contracts today. The point that I'm trying to make over here is you're getting order flow just shoved right in the face, okay, of markets, and it's actually driving an individual stock like this. You have to recognize with mega market cap, if you can drive enough call buying, okay, early on in a trading session into a product, you can actually drive the entire Nasdaq. And that's what trading firms are effectively doing. Okay, they're just driving order flow right down the throat of this. And again, now this is news related. It's a deal with GM, yada, yada, yada. It's a big gap up to the upside. Want to see something really crazy though? Okay, we're going to look at an inverted implied volatility skew. Now I'm going 98 days out because I use a strategy called Ultima, little volatility arbitrage that I take advantage of. But what I want you to see, right, when we start talking about, calls and puts and implied volatility skew, look, here's implied volatility. At the money implied volatility, okay, is roughly 53%. As you go further out of the money, the implied volatility actually goes higher. All right, so this is what we call an inverted implied volatility skew. I went out and actually sold options in here, and you got to have a huge amount of margin to do this. Okay, this is not a trade for everybody, and I'll talk more about that later. But I went out and actually sold options out here, like a 65 vol. Gold, Jerry, it's gold. Like, you got to recognize, like, how wild is it when I'm selling, get this, I'm selling the 450 calls, okay? And I sold them today for $2, $2.30, okay? And I sold some size in here, so I'm selling the 450 calls. We're not even trading at 250. I mean, this stock would have to gain almost $600 billion more in market cap to get up to the 450 level. And I got to tell you, even if the market does rally huge, what will happen is my 65 vol will slip down the skew ladder, and I'm not going to lose that much money. So it can rally all it wants. It's actually a great position. It's rare to see such a wild inverted skew. The last time we saw skews this inverted, you got to go back to the ridiculous nature of 2021. And I got to tell you, okay, it's extremely, extremely advantageous. That's why I talk about, again, feel the wrath of the Nasdaq. Feel it or take advantage of it. Now, some people may not like that position because it takes up a lot of margin. There's a lot of different ways to do positions like that. Okay, but an inverted implied volatility skew, step right up and fire at will. It's similar actually in NVIDIA, and I did almost the same position in NVIDIA. You go, it sounds scary. Hold me. The at the money implied volatility, okay, on the calls is 47%. You go way out of the money here, it jumps all the way to about 52, 53%. Earlier today, I was actually selling closer to a 55 vol inside of the 650s, people, in NVIDIA. Think about that. It's not even a $400 stock. I'm selling the 650 calls in here in size, and I'll cover them. Okay, I'll cover them for like a 50% gain if I get the opportunity to do so here in the near future. Anyway, the mega market cap, all right, with inverted implied volatility skews is a little bit of a tell. You have to ask yourself, how long can that actually sustain itself? And it's not like I'm not going out there and, avidly shorting into Tesla. And I want to make that very clear. I am not stepping to the plate and shorting Tesla. Okay, I am selling way out of the money calls in a ridiculously inverted implied volatility skew. All right, knowing that over time that this is probably going to normalize. And it's one of the most critical things. Like, I don't want anybody to go out and go, oh, he's getting short in Tesla. I'm not getting short in Tesla. Yeah, I got a little negative delta here and there. Okay, but I'm actually taking advantage of a nice inverted implied volatility skew. Speaking of implied volatility skew, one of the other things that really resonates with me here is the implied volatility skew in the SPX is almost record breaking here. We're at 155. Now, I have no idea today where the IV skew is going to be. My guess is it's very fairly close to where it presently is, but a 155 skew, for those of you that do not speak geek, look how high. I mean, we're almost at the all-time record, almost at an all-time record in terms of IV skew. What this basically means is that the out-of-the-money puts are trading at a record premium versus out-of-the-money calls inside of a product like SPX. In this case, I'm actually going to show you spiders. Look, let's go to the spiders. Let's go to the 35-day options. Okay, here's the point. The out-of-the-money puts, okay, out-of-the-money puts, they're all jacked up in premium. You know, the at-the-money and the average, okay, is probably like 12%. Look, the at-the-money options are trading for 12% IV. The out-of-the-money options on the put side are trading for like 25 vol, okay, and the out-of-the-money calls are trading for like a 9.5 vol. There's this huge, just gaping hole between the put implied volatility and the call implied volatility, hence a heavy skew. How do you take advantage of that? There's a lot of ways, but what we do is actually called Ultima or inflection point spreads. Okay, and it's something that we again, we've sold a lot of premium very, very successfully in these markets. As long as you're hedging, you're going to be just fine. Now, that's what's going on in markets. And again, markets this past week, I don't want to tell you that they're all like awe-inspiring. Here, look. Okay, we're actually going to cruise into the SPX. You know, ironically, the S&Ps did finish the week ever so slightly higher, and that really it takes everybody off guard because I say feel the wrath of the Nasdaq. Okay, the reason you want to feel the wrath of the Nasdaq is some of the biggest stocks in the Nasdaq actually closed down in the week dramatically. Right? It's all about Tesla at this point. That's just bid. Tesla has a bad day. You might feel a little differently. So how can the SPX be up on the week? And the answer is take a look at the financials. Okay, the financials actually closed the week just towards the upper edge of the expected move. The energy sector this week actually closed towards the upper edge of the expected move. Okay, but it doesn't really make a difference. You know, when people talk about all the time, there's 11 sectors in the S&Ps. Yeah, you know, guess what? There's really only one that truly matters, and that's going to be tech. You know, and coming up in a very, very, very distant second would be like financials and then energy. But financials and energy, okay, sustained the marketplace this week as the S&Ps would have finished unchanged. But again, financials and energies had a little bit of a bid under them. All right, so we're seeing mega market cap really showing signs of stress with inverted, you know, implied volatility skews. The IV skew in the entire marketplace is record highs, and we're coming into a Fed week. So we're about to come into a week where the FOMC is going to speak. And what are they going to do? It's what I say, will the Fed place its pause on the markets? For those of you that have no idea what I'm talking about, the Fed is very likely to pause interest rate hikes. And that, people, is not me. It's that's designated by right here. Look, current target rate is 5.25. There's a 30%, again, about a 30% chance, okay, of a 25 basis point hike. So I'm just going to give you, for what it's worth, my take. My take is this: Fed does absolutely nothing. They actually hold rates consistent at the 500, 525, okay, but they make very bold statements. And again, this is completely, all right, my logic on here that the Fed is going to make some very bold statements about the possibility of future rate hikes to really put a little unease to the marketplace. You have to be careful this next week because the Fed could come out swinging. And I mean that with all due respect, is a lot of other banks, and ECB's also got an announcement, but a lot of other banks have continued to hike. I actually think that the Fed is going to not necessarily raise rates here. They're gonna pause. They are gonna pause. Okay, they're not gonna put their paws on the markets, but they're actually going to pause the rate hikes for the time being, but threaten future hikes. Okay, and they're going to be very, very data dependent. Okay, the other aspect that's also pretty critical, and people talk about this constantly, is the triple witch will return to the marketplace this next week. For those of you that have no idea what triple witching really breaks down to, okay, it's a major expiration of what? Futures contracts. When we talk about futures contracts, if we look at the ES, okay, the ES is actually going to roll forward. Right now we're trading June S&Ps. We're going to be trading SEP S&Ps. And the only difference, like people get all carried away with this, right? Right now you're trading an M23. Next week you're going to be trading U23. In fact, okay, most platforms are actually going to make the next active contract. Okay, you're going to come in on Sunday or Monday. You're going to look at it. Okay, and you're going to be trading U23. Get used to it. And I'm going to tell you something right now. It's very important because markets right now are trading at 43.07. But Okay. On Monday, you're going to be all confused because you're going to be trading what? 43.51. There's a pretty big difference, all right, between front and back month futures contracts. And that roll will throw a couple people off, but it doesn't really mean anything. And when you're actually charting this stuff, when you start looking at the charts, you come up here, if you're on Thinkorswim, click on the little sprocket, you go to futures contracts, and you have to go adjust for futures contracts. You have to make it what's called a continuous contract. So adjust for contract changes, hit apply, hit OK, because otherwise your technical analysis is worth absolutely nothing. But in the triple witching, what you have is your futures contract rolling forward. Then you have obviously index options that are going to expire like SPX. Then you're going to have equity options expire. Look, that happens every week anyway. I don't put a huge amount into the triple witching, but I will say this. When it pertains to the SPX, this contract right here that I'm in, it's the June 16th AM settlement. If you go pull up like volume and open interest, it is awe-inspiring, people. And pull up volume and open interest. Go ahead, go scroll through it. Scroll through it. Talk amongst yourselves. As you start to pull up like, the open interest in here, it's freaking huge. And that is cause for concern because what can transpire is you got to realize like billions and billions of dollars, are coming off the books. And coming off the books basically means like, look at some of the heavy contract size that's in here in terms of open interest. It's not nearly, though, as critical as it used to be years ago, because years ago you would only have like a monthly expiration and everything was dependent upon that monthly expiration, right? But it's still, there's some serious size that's going to be coming off in terms of open interest. And that could actually, return volatility with a vengeance. So be a little cautious coming into, of course, this triple witch. And again, the triple witching, toss it aside. The only thing that really matters, is the heavy size that's inside of the SPX, in my opinion, because heavy size in the SPX constitutes that you're going to have to relinquish many a hedge inside of the S&Ps. All right. So again, feeling the wrath of the Nasdaq. Nasdaq is going to be the talk of the trading community again next week, as maybe some of that order flow starts to flip over in a few of those tech stocks. Next in the docket, get your trade on this week's profits and losses. First of all, I placed a bearish trade inside of Meta. It worked. Like, how many people can honestly say that they put bearish trades on lately inside of tech and they worked? So I closed out of a Meta trade this week. Some sell side activity actually helped me out a little bit. And again, I broke up the trade into a lot of different pieces over here. But when it comes to Meta, opening and closing positions, all right, just some spreads that I put on. All right, moving forward from there. Additionally, I closed out some S&P options on futures puts, opened some more puts. So this is something I talk about like each and every week over here. Look, close some puts, close some calls, opened up more puts. That's what I do. I sell premium, cover it for like a 50% gain. Boom, move on. So not only did I close some S&P puts, I closed some micro puts as well for 50% gains. I opened up new S&P short puts. I actually rolled up because I had existing hedges in place. Lastly, as I already described to you, I went into Tesla, I went into NVIDIA, and I took advantage of a wicked, just wicked implied volatility skew. One more time, I do want to, mention this a little bit. Look, people, if you've never really spent time at an option chain, you got to check this out, because if you look at Tesla, it closed about 244 and change, right? 244 and change. So just bear with me here for a second. I want you to go about $40 out of the money in the put side, right? About $40 out of the money put side. And what does that bring you to? About the 200 strike. Look, that option's trading for a 55 vol. Then, let's get crazy. Let's go, 40, 50 bucks to the upside. Like, look, all right, here's an option. It's trading for like $8.40. I'm going to get crazy. I'm going to go all the way to the 300 strike, which is even further out of the money. It's trading a 54 vol, but the option's actually trading for 11 bucks. That, people, is what an inverted implied volatility skew can do for you. The out of the money calls are trading for a significant premium over the out of the money puts. And it's just so rare to see that. And that's when you really want to take advantage of it. That's why I wanted to cover it and get your trade on. Last but not least, what we cover each and every week here at TheoTrade, of course, is expected move. This week, I got to tell you, it's abysmal, right? The reason I say that is if you take a look at the SPX, right? The SPX, the mother of all products. What'd you see this week? Oh, we had nothing followed by a nothing, okay? With a nothing burger, there was a little bit of a bid on Thursday. And today, what did we do today? Nothing. We threatened to rally, then we actually faded. Net, where did we end up in the week? Okay, look, okay, the SPX started the week, and again, I like to highlight here, what's here? Just north of 42.80. Where did we finish the week? 42.98. So the SPX was up just about not even 20 bucks on the week. The expected move is $55, and we got close, but absolutely nothing is painful. It was actually a little painful this week. And of course, this is where people go, the VIX collapsed. Yeah, the VIX collapsed, except Skew picked up. Yeah, go figure. The VIX, again, it's age old. Like, I wouldn't even bother looking at the VIX anymore, because if you're selling out of the money premium, who cares about VIX? Go look at those out of the money puts. Those things are not trading for like a 13 vol. Those out of the money puts are trading for like a 25 vol. And if you really know what you're doing, and again, if you really know what you're doing in this business and you want to sell some volatility, okay, you're going to learn a little bit about Ultima. And I'm telling you right now, look at this, like 112 days out. I just want to make a quick point. 112 days out. Come over here to like Delta. Okay, you look out here like a 6 Delta. See, I've got positions on that one. Why do I have positions out there? Ooh, I have an answer to that. Because I'm selling almost a 25.5 vol. Okay, where you're like, but the VIX is only at 13. Yeah, and I'm selling a 25.5 vol. Okay, sold. Do I hedge? Absolutely. I've got inside hedges over here. Okay, I want to mitigate my risk. I don't want to take a huge hit if the marketplace tanks out there. So with that, in the SPX, it's a very, very docile week. But what's coming next week? Well, it's going to be a little up tempo, if you will. Taking a look into the SPX, okay, we're going to look exactly 7 days out. We're going to knock down the number of strikes. And here, okay, the most striking thing, we're going to have right around a $65 expected move. Okay, that's pretty accurate too. It's about $65.20 is an accurate expected move. So yeah, why am I bringing that up? Because this past week we had a $55 expected move. The expected move is going to jump up to $65. What's different this next week? Well, this next week, of course, okay, is going to be chock full of fun with Jerome Powell hitting the main stage, putting his paws on the markets. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.